Welcome to Fixbook. Today's trade of the day is a buy recommendation for USO. I'm going to show you how to take a bullish position in a better way than just buying shares. We'll focus on why USO is a great buy right now, and why using options can maximize your returns. By the end, you'll grasp bull call spreads and amplify returns. Let's get started. A bull call spread is a bullish option strategy. Traders use it when they expect a moderate price rise. It involves buying and selling call options with different strike prices. Buy one call option with a lower strike price and sell another with a higher strike price. The bought call gives you the right to purchase at the lower strike price. The sold call offsets the cost and defines your profit potential. It also dramatically reduces the impact of theta decay as a buyer. Single options lose money every day to theta decay. Using a spread like this protects you from extreme theta decay. Let's move on to USO's recent price action. Before diving into the bull call spread, it's crucial to understand USO's current price action. USO is trading at $70.24. Observing USO's daily chart provides insights. USO has been consolidating within a tight range. This suggests low volatility, with price hovering between support and resistance. Now let's explore how Bollinger Bands enhance our understanding. Bollinger Bands visualize price volatility and potential breakouts. They consist of a simple moving average, an upper band, and a lower band. Using Black-Scholes options model, according to live options data, 95% of the time the price action will stay below the top band, and 95% of the time, the price action will stay above the bottom Bollinger Band. USO's tight Bollinger Bands confirm low volatility. This tight range shows USO trading within a defined channel. A bull call spread thrives with a moderate price increase. Now let's move on to the specifics of the bull call spread trade. Let's dive into the mechanics of this bull call spread. Buy a call option with a $75 strike price. I used April 17, 2025, approximately 130 days to expiration. This is a price level USO can reach by expiration. The expiration date is the last day the option can be exercised. Remember, options come with an upfront cost, the premium. Note that this trade was filled on December 6th at 3:12 p.m. To offset the cost of buying the $75 call option, we will sell a call option with a higher strike price of $80. Also, April 17th, 2025, 130 DTE. By selling this call option, we agree to sell 100 shares of USO at $80 if exercised. The premium received helps offset the cost of buying the $75 call. The expiration date of the $80 call option is crucial. It determines the time frame in which the option can be exercised. Selling options to offset costs and manage risk is fundamental in options trading. The beauty of a bull call spread lies in its defined risk profile. The net cost of entering this bull call spread is $150 per contract. This represents our maximum potential loss, no matter what happens to USO's price. Even if USO plummets to zero, our maximum loss is still limited to $150. In the next section, we'll explore the exciting part, calculating the maximum profit potential. Now let's talk about the exciting part, calculating the potential profits of this bull call spread. The maximum profit is limited but significant compared to the initial investment. If USO's price rises to $80, the $75 call option will be worth $5 per share. Each contract controls 100 shares. That's a profit of $500. After paying a net premium of $1.50, our maximum profit is $350 per contract. This potential profit comes with significantly lower risk than owning the shares outright. To understand our USO bull call spread, we need the break-even point. It's calculated by adding the net premium to the lower strike price. Our break-even point is $76.50. Above this, we start making a profit. Below this, we incur a loss, capped at $150. Profit increases as USO's price moves closer to $80. At $80, Profit reaches $350. Understanding the break-even point and profit range is crucial. To understand our USO bull call spread, we need the break-even point. It's calculated by adding the net premium to the lower strike price. Our break-even point is $76.50. Above this, we start making a profit. Below this, we incur a loss. Profit increases as USO's price moves closer to $80. At $80, profit reaches $350. Understanding the break-even point and profit range is crucial. To grasp the advantages of our bull call spread, let's compare it to buying 100 shares of USO outright. With USO at $70, buying 100 shares requires $7,000. If USO hits $80, our shares generate $900 profit. This ROI is respectable, but let's compare it to our bull call spread. Now, let's shift our focus back to the bull call spread. We entered this trade with a net cost of $150 per contract, significantly less than the $7,024 for buying 100 shares. If USO hits $80, our bull call spread will generate $350 per contract. This is a 233% ROI. By utilizing options, we've amplified our potential return significantly. This highlights the unparalleled potential of options trading for maximizing returns. The true power of options, especially the bull call spread, lies in return on buying power. Buying 100 USO shares ties up $7,024. Even if profitable, that capital remains tied up. With a bull call spread, we risk only $150. This leaves $6,874 available. Efficient capital use is where options shine. Let's delve into return on buying power and why it's crucial for traders, especially with limited capital. Buying shares outright, returns are proportional to your capital. Options trading introduces leverage. You're buying the right to trade at a certain price. In our USO example, we controlled 100 shares with just $150, compared to $7,024 outright. This is the leverage options provide. Let's tie this back to opportunity cost. Every dollar you invest can earn a return elsewhere. Options with leverage free up buying power. Instead of $7,024 locked in USO shares, we have $6,874 available for other trades. This efficient use of capital sets options trading apart. Imagine you have $10,000 to invest. With traditional stock buying, you might be limited to a handful of positions, but with options, you can participate in more opportunities. Allocate a small portion to different bull call spreads, targeting various assets or sectors. Spread your risk, capitalize on trends, and potentially amplify returns. Remember, the ROI can be substantial. In this particular example, 233% when using a spread vs 14% when using shares. Option strategies can enhance your return on buying power, helping you achieve financial goals faster. This bull call spread on USO isn't just about higher returns. It's about making a calculated trade where rewards outweigh risks. One compelling aspect is the defined risk. Unlike shares, our maximum loss is capped at $150. This is crucial in volatile markets like the energy sector. Oil prices are influenced by many factors. These factors can lead to unpredictable price swings. Limiting our risk to $150 shows we believe in USO's potential. This balanced approach is key to sound trading. The bull call spread allows us to participate in potential upside. Risk management is often overlooked by novice traders. Experienced traders know managing risk is crucial. Let's talk about leverage. Leverage lets us control larger positions with less capital. In our USO bull call spread, we control 100 shares with $150. This boosts ROI but magnifies losses. Strategic strike prices and defined risk are key. This sets successful traders apart. Options trading offers defined risk, leverage, and potential high returns. It requires careful consideration and education. Understand options contracts and risks. Use educational resources and simulations. Knowledge is your most valuable asset. The USO bull call spread offers a compelling opportunity for traders. It combines defined risk, leveraged returns, and capital efficiency. Monitor the position closely and adjust as market conditions evolve. Pay attention to technical indicators and market sentiment. Adjust your position if USO fails to gain momentum. Successful trading is about managing risk. The USO bull call spread can be valuable. Conduct thorough research and consider your risk tolerance. Good luck with your trading journey.